Home Depot just released their most recent quarterly earnings. So what we're going to do in today's video is go through some of the slides from their most recent investor presentation. We'll be looking at their most recent quarterly earnings in detail, and then we'll be doing some trend analysis on Home Depot's financial metrics. So if that's some content you'd be interested in watching, I encourage you to watch the video. And if you like it, give me a thumbs up and subscribe to the channel. So without further ado, just going to dive right into the video. So as we can see here, Home Depot makes up roughly 2.8% of this total YouTube dividend growth portfolio here, provides me with about 3.6% of my total annual dividend income. And when we look at it on a dollar basis, Home Depot, that's roughly about $30 every year in US dollars. Now, on my position, I'm currently up about 3.32% on Home Depot. Now, let's go and look at those slides on the investor presentation. So what is Home Depot's strategy? So again, if you haven't watched my channel, I own a decent amount of Home Depot, and I've actually done videos on Home Depot and Lowe's in the past, so I encourage you to watch those. But basically, Home Depot is part of this duopoly in the home renovation and home construction space with Lowe's. So they try to sell these home renovation, home building supplies to both consumers and to professional builders. So their strategy has been to focus on growing their market share with both professionals, or pros as they call them, and consumers, so regular customers like myself and possibly you. Now they also want to create exceptional shareholder value here as their objective as well. So that's great to hear as one of their shareholders. Now, how do they do this, or what are the strategies that they implement to get these objectives attained? So they deliver best customer experience, they develop differentiated capabilities, and they extend their low cost provider position. So again, focusing on the customer, the capabilities that they have within their ecosystem or their business, and then trying to be a low cost provider, trying to gain market share through that. So they say they're stronger, more agile company today than they've ever been, and well positioned to capitalize on future growth opportunities in their market. So what have they done since 2019 to 2022? So they say they've invested from a position of strength and driven significant growth. So when we look at those financial results over the past 3 years, it's been about 47 plus and 47 billion plus, in sales growth. So huge sales growth over this past 3 year period, and 60% plus diluted earnings per share growth. So again, great financial metrics here from Home Depot. So they've had a backdrop of strong macroeconomic fundamentals for HI, or home improvement. Now they have an attractive core customer base that is specifically focused on homeowners. So they say they have a lot of tailwinds for the medium to long-term repair and remodeling activity. So again, focusing on homes that are going to need repair and remodeling, not just new construction homes. So 80% of their consumers are homeowners. They have about 40% plus of an increase in home equity since 2019. So again, from 2019 to basically 2022, there was that huge housing boom with interest rates being artificially low, and thereby increasing prices and increasing home equity for homeowners in the rough range of roughly 40% plus. So in terms of months of supply of single family homes, still at an all-time low, so 2.9%. Here focusing on the supply demand of homes, they're still saying that there's an undersupply or a shortage of housing in the United States and Canada. 50% plus of homes are 40 years or older. So again, here focusing on the age of homes, saying that as homes age, they need to be repaired or remodeled. So when you have an aging housing stock, they're going to need to visit Home Depot in order to gain building supplies for these repairs and remodeling or renovations. So they state they are strong stewards of the business, and they have a couple of ways that they focus or shift the strategic direction of the business. They have natural levers that they can pull, and reduction in fixed operating costs. So these natural levers, so labor model adjusts with sales demand. So again, not specifically stating here, but they're saying as sales demand increases, they can hire more people, hire more part-time people. And then the opposite also consequently happens. As labor decreases, they can then put some of those people on part-time hours or reduce their total labor force. This improves the cost environment as well, and a reduction in fixed operating costs. So they've made a commitment to reduce those fixed operating costs, resulting to about 500 million annualized costs out for fiscal 2024. So, what are their financial objectives? Number one, they want to capture market share. So, again, Home Depot, they've only had about 17% of the total addressable market here in the United States. So, they can continue to capture market share by providing or committing to be a low cost home renovation, home building supplier. And they want to create shareholder value. So, that's great. They want to create shareholder value here by focusing on total shareholder return. So, again, that's dividends, buybacks, and share price appreciation. All right, so we're going to look at this guidance that they provided, and they reaffirmed it again here recently. So for fiscal 2023, they stated that total sales or comparable sales will be down between -2 to -5%. And again, they've settled in that -3% range. And it's a hard comparable, fiscal 2022 to 2023. So again, being down here, as we know, housing is cyclical and home renovation is cyclical. So it does have their periods of great growth and then some little declines as well. So that's to be expected. Operating margin still in that 14% range, tax rate at 24.5%. Interest expense, they do have a lot of debt. We'll look at that later. Roughly about 1.8 billion. And diluted earnings per share falling here between -7 to -13%. Again, here it's speaking to that cyclicality. So you have to be okay with these cycles where housing can go up significantly, but it can also have significant drops, or depending on what's happening in the housing market and the economy. All right, so this is speaking to that total addressable market. So that market share, like I said, is close to 17%, and 83% is still uncaptured by Home Depot. Remember, a decent amount of this, around another 17%, is captured by Lowe's, that other significant player here right behind Home Depot. But again, there's still a lot of room to capture market share in the US, Canada, and Mexico. A lot of this market share is from like mom and pop stores, home renovation stores. So if Home Depot can continue to grow and kind of force these other stores to either close or get bought out or whatever have you, then they can continue to grow in this sector. Now, the total addressable market here, they say it's roughly about 950 billion, with about half being made up from consumers, so that's regular people like us, and the pro, or those builder, remodelers, renovationers, small home builders, and trade pros here. So again, focusing on both of these here. And they state they have a $43 trillion residential housing base, again focusing on the total addressable market here. All right, so let's look at their most recent quarter and the performance that they had. So they had 37.7 billion in sales. That was down about 3% from the prior year for the same quarter. And again, for the comparable, down about 3%. This resulted to diluted EPS, or earnings per share, of $3.81. So what did their CEO, Ted Decker, state? He stated they remain very excited about their strategic initiatives and are committed to investing in the business to deliver these best interconnected shopping experiences, capture wallet share with the pro, again, stressing here their focus on that pro market, and grow their store footprint. In addition, their associates did an outstanding job delivering value and service for their customers. So as we can see here, they have some highlights. So they have their sales leveraging digital platform, that increased by 5%. So this is a good focus, focusing on digital platforms for consumers. They had nearly half of online orders fulfilled through their stores, meaningful improvements on their shelf availability of products for consumers, and another record year of Halloween sales. So again, focusing on specific segments or specific seasons. Halloween here was big for them, another record year. And again, I walked through Home Depot and there was some pretty cool stuff when I went Halloween shopping. So now, as we can see here, the company overview, it is the largest home improvement retailer, with retail stores in 50 states. And they again have 2,333 stores at the end of Q3, most of it in the US and then some in Canada and Mexico as well. So let's go and look at the numbers here. So this is the most recent quarterly earnings. So again, this is the income statement. So we're going to be looking at this. And this is for the past 3 months here that just ended. And this is for that same period in the last fiscal year. and this is for the year to date, or the 9 months, for both 2023 and 2022. So as we can see here, that net sales of roughly 37 billion compared to 38 or 39 billion. So that's down 3% like they stated from the previous year. The cost of sales falling in line with that as well, resulting in gross profit being down about 3.7% to about 12.7 billion compared to 13.2 billion. And when you look at it year over year, it's basically the same, down about 3.4%. It's roughly 39 billion, down from 41 billion in the previous year. Like I said, it is a cyclical business, so that's something you need to be okay with when looking at possibly investing in Home Depot. So how about their expenses? So their expenses actually shot up a bit here. So selling, general and administrative, or SG&A, 6.6 billion compared to 6.4 billion in the previous year. And then again, when you're looking at the total operating income, that's the gross profit less these expenses and amortization, roughly $5.4 billion compared to $6.1 billion in that same quarter last year. So a decent drop here, 12% of operating income drop. So it was a large drop. And again, like I said, this is to be expected. Interest rates have risen. The housing sector has kind of leveled off here. So not as many people buying or building new homes. They are again focusing more on servicing the debt associated with those mortgages. And when you look at it for the last 9 months, it's down about 9%, 17.5 billion compared to 19.2 billion. But again, still great numbers here in my opinion. And when you carry it down for the interest and the taxes and other items here, you can see that the net earnings are 3.8 billion compared to 4.3 billion. So roughly still down about 12%. And when you look at it on the 9 months to date, 12.3 billion compared to 13.7 billion, still down about 10%. So what I really like about Home Depot though is they do focus, like they said, on that shareholder return or creating shareholder value. So when you look at their common shares outstanding for this quarter, you can see 996 million compared to the 1.2 billion here. So they actually reduced their share count year over year here by about 2.4% in that quarter. And then when you look at it on a year over year basis, 1 billion compared to 1.024 billion, and reducing that share count again in that 2% range. So they bought back about 2% of their total shares outstanding. Now this again does sort of artificially inflate this earnings per share number. And again, it's roughly $3.81 compared to $4.24, so down about 10%, and $12.28 compared to $13.37 for that year over year. But still reducing this share count here at 2.3% and 2.2%. So again, buying back those shares and canceling them, thereby making our ownership as Home Depot shareholders that much greater. So that was the income statement. Let's go and look at their balance sheet. So please remember the balance sheet is a snippet at a point in time. So we're going to be looking at their balance sheet for the October 29, 2023 compared to October 30th, 2022. So let's look at their current assets. So again, these are assets that can be converted into cash or inventories or sales comparably fast, roughly within a year or so. So cash roughly 2 billion compared to last year was 2.4 billion, so a lower cash balance. They have a higher receivable balance here, slightly at roughly almost 4 billion compared to 3.7. And inventories, I like to see this, they are reducing their level of inventories from the previous year, 22 billion to 25 billion. We can see their total current assets of 30 billion compared to 33.6 billion. They have some property, plant, and equipment here, and some assets. Again, this right here is just IFRS 16. So again, I don't really look at it as an asset because you have a corresponding liability here. So again, this is just basically the rent or the rental payments that they have to make for their stores. You get to a total asset of roughly 75 billion. So let's look at their liabilities. Now, what I like to see in a healthy balance sheet is a low level of debt compared to their cash. So we can see their current installments of long-term debt are roughly 1.3 billion. So again, they can service that with the cash that they have on hand if they wanted to. But Home Depot, just like Lowe's, they are very highly indebted companies. So when you look at their long-term debt, it's roughly $40 billion compared to the 41 billion in the last year. So again, that has slightly gone down, but it's still relatively the same. So one thing you need to note is, like I said, these companies are very indebted companies. They take on a lot of debt, but we'll look at their cash flow statement and see why. So again, their balance sheet, in my opinion, roughly hasn't really changed that much over the past year. which again isn't really a great thing. Like, not like they're paying down a lot of debt, but it's not a horrible thing because they're still generating positive cash flows and positive net income. So let's go and see what they do with the cash that they generate from their business. So you take that net income that you had, that 12.3 billion, and again, this is looking for that 9 months. So again, 2023 compared to 2022. And then you adjust for any non-cash items such as depreciation and amortization, any stock-based compensation and changes in working capital. Roughly 16.4 billion is the net cash that they get from these operating activities compared to last year, which was 10 billion. So again, that's a decent amount of cash here from their operating activities. So that, in my opinion, is great for this year. Now, looking at their investing activities, of that 16.4 billion, they have to reinvest roughly $3 billion back into their business. So that's focusing on CapEx for their stores or their business. And then they also have to focus on other payments for any businesses acquired and things like that. So roughly $3 billion is what they need to reinvest into their business. Now, if we scroll down a little bit, we can see these financing activities. So they repaid roughly $1,200 of long-term debt, and they repurchased a lot of common stock. So 6.5 billion roughly. That's how much stock they purchased and canceled. So comparing that to the previous year, they purchased roughly $5 billion. So again, they increased the amount of buybacks that they did here, which is great in my opinion. And when you look at the dividends as well, $6.3 billion of cash dividends compared to $5.8 billion of cash dividends in the previous year. So they increased the amount of common stock purchases for cancellation, and they also increased the dividends. So again, great job here by Home Depot. And like I said, when you look at that cash flow, that 16 billion less that 3 billion leaves you with about $13 billion here of cash flow. And they use all of that to reward shareholders by buybacks and by cash dividends. So again, not a lot of room to reduce that debt, but if they actually reduced these buybacks or these cash dividends, they could, in theory, pay off this debt fairly quickly. But what they do here is they employ leverage, so they use that debt, and then they finance their company, and they use that debt to purchase back stock as well as issue cash dividends. But if they use this cash flow, instead of focusing on common stock, they could potentially pay off a lot more debt. In my opinion, I actually wouldn't mind if they use some of this cash flow and started paying down debt, even if it was like 2 or 3 billion a year. That would actually speed up the health, in my opinion, of their balance sheet, make it look a lot better. And again, I wouldn't really mind that, but there's so many schools of thought on what you can do. So if you're repurchasing stock and dividends, a lot of investors like that as opposed to paying down debt. In my opinion, I would like a combination of the three. So a larger focus here on paying down the debt would not be too bad in my opinion, just my personal preference. But again, different investors have different investing goals and investing needs. Some do like buybacks and dividends a lot more than paying down the debt of the company. So let's go and look at Home Depot here on Stock Unlock, and let's go and see some of their financial metrics. So they have a market cap of roughly $307 billion, so a large market cap company here, operating the retail, I consider them consumer discretionary sector, earnings per share of $16.18, trade at a price to earnings of roughly 18 to 19, forward price to earnings of roughly 19, a nice dividend yield at 2.72%, and we'll be looking at some of these other metrics here as we go through the tabs. So let's go and look at the insights page. So again, Stock Unlock here gives them a 3.67 rating here. Various analysts rating them here. And again, we're going to, analysts take all their ratings with a grain of salt. It's always better to do your own research. So let's go and look at their income statement. I'm going to be looking at some trends here. So their revenue, as we can see here, their revenue from 2008 to 2007 and 9 did slightly drop here during the financial crisis, but over the past 10 years has grown nicely year after year. So growing from 68 billion roughly 10 years ago all the way up to $157 billion. Now we know revenue is not the end all and be all. It needs to translate into positive net income growth. So when we look at their net income or their earnings, again here, it's roughly the same trend, growing exponentially from 2.6 billion all the way up to that $17.11 billion range. So great growth here, in my opinion. Now let's look at their shares outstanding, because they did buy back shares, as we saw that in that 2% year over year, and they have been buying back shares at a nice clip. So 10 years ago, they had roughly $2 billion of shares outstanding. So again, sorry, this is a little bit longer than 10 years ago. Roughly 15 years ago, they've actually reduced that share count very nicely, very aggressively, bringing it down to basically in half. So about a million shares right there, billion shares, compared to the 2 billion that they had previously. So cutting that share count in half, increasing your equity ownership in the company over that 15-year period, like we saw by implementing that form of leverage. Now, as a result, your diluted earnings per share will also skyrocket, because you're also you're earning net income and your earnings and your cash flow, but at the same time you're buying back shares and canceling those out. So that has also increased very significantly as well. Now let's go scroll back up and let's go and look at those dividends. All right, so Home Depot, roughly 2.72% dividend yield, represents $8.36 of dividends per share. A nice dividend growth rate here. So 5-year CAGR, a compound annual growth rate of 15.20%. So great dividend growth here, in my opinion. Payout ratio. So the normal payout ratio here stated is on a net income basis, and you also have a free cash flow payout ratio. Again, looking at it, I usually don't look at the net income payout ratio, because that's subject to specific accounting adjustments. But when you look at the free cash flow payout ratio, they're relatively the same, roughly 51%. So what I would really like to focus on, the free cash flow payout ratio. That's how much free cash they generate and are able to pay out as dividends, roughly 51%. So very safe dividend here, in my opinion, and a lot of room to grow that dividend here for the future. So scroll down. Now let's look at the total returns. So roughly over this 10-year period from 2013 to 2022, or 2023, sorry, we have the S&P 500 here in this light gray, and then we have Home Depot here in this blue. So as we can see, the total return here for the S&P 500 compared to Home Depot, roughly S&P 500 was 235%, and the Home Depot total return, again focusing on the dividend and the share price appreciation, was roughly 425%. So a little over 1.8 times of growth. So again, Home Depot here handily beating out the S&P 500. Just great shareholder return here for Home Depot over the past 10 years. All right, so let's go and look at that dividend per share. And again, it's a nice step ladder here. They continually have grown their dividend at such high rates and focused on returning the shareholder capital, or returning that value to the investor in the form of dividends and buybacks. So that was Home Depot. I hope you enjoyed the video, and let me know what you think about their most recent earnings. Did you like them? Did you have any qualms, or did you have any comments? Please leave all that in the comment section below, and I will see you in the next video. Take care. Bye. Please note, I am not a financial advisor by any means. This information is merely for your information purposes only. Please do your own due diligence when investing in stocks. Stocks are inherently risky and you may lose money. I'm not liable for any investing losses or any investing decisions you make. Thank you. Bye.